What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're taking a look at Marathon Petroleum stock. This is ticker MPC, and this video is dedicated to Carson, who requested I make this. So let's get started here and take a look at the stock chart. What we're going to see is that over the last 5 years, this stock has gone up 82%, and this company is currently sitting at a $57 billion market cap. Now, if you don't know, you probably are pretty familiar with the brand Marathon. But if you don't know, they, as it says here, they engage in refining, marketing, and transportation of petroleum products in the United States. So, and it says it operates through the following segments: refining, marketing, and midstream. So that's what they do. And as you know, the last couple of years have been pretty crazy for the energy industry, and a lot of energy companies have gone up a lot. And so Marathon is one of those. Now, I looked up the world's largest refining companies, and Marathon comes in at number 6 on that list. So they are a very significant player in this space. And if we take a look at their revenue, we can see that the first thing I want to get out of the way before we get into this is when we're dealing with companies like this, one thing you have to be careful of, you have to treat this like, okay, this is going to be a very cyclical business and a company that is subject to the ups and downs of that market. So, for instance, since this industry has been so hot the last 2 to 3 years, that's why this stock went from $30 to $123. But if you look at prior years, such as 2010 to 2018, you can see things are somewhat stagnant. It's hard to predict this type of market. It's not a traditional business that you can say, okay, they're going to consistently grow revenue at 20% per year. This type of business doesn't really work like that. So you have to keep that in mind. And that's what you're going to see. I mean, keep in mind, this is still a huge company. Even if they have an off year or a moderate year, we're still talking they're doing, anywhere from 50 to $100 billion of revenue, which is huge. So you have to keep that in mind as well. But on a bad year, we're talking 2009, they did 45 billion. On a good year, 2019, they did 123 billion. So keep that in mind. That's why when I have to check off, is this a increasing revenue or net income graph? It's hard for me to say because it doesn't really work that way. It's not like straight up or straight down. It's like up, down, up, down, down, down. It's all over the place. It's hard to predict. So but I mean, overall, you can say that we can see some improvement and some increase there. So you could say that's a check, but I very, very easily could see somebody interpreting this as saying, no, there's not consistent improvement or increases in the numbers. Like net income is a good example. From 2008 to 2019, there wasn't a huge jump. I mean, 1.2 billion to 2.6 billion for 11 years. That's not that much. And if you look at 2011, we're talking the same numbers almost. For 8 years, they did almost the same numbers of around $2.5 billion. So keep that in mind. And then 2021, it went all the way up to 9.7 billion. And in the next couple of years, we're probably going to see it come back down to $2.5 or $3 billion of net income. So you could say you see some increase. I mean, honestly, I want to give that a no. I'm going to give net income a no because that one it really does not show consistent growth. So let's see, what do we have here? So this is going to get 11 out of 16. Now, if we keep going, the price to earnings is another thing. Price to earnings of a 4 right now, because we're talking about a $57 billion company that just did $14 billion of net income, right? So keep that in mind. That's why the PE is so cheap. But as soon as their numbers come down, which they will, they might come down 50%. This stock is also going to come down 50%. So just keep that in mind. Don't be surprised if this stock comes to $60 again, unless their earnings just keep going and going and going. But that's only going to last for so long. Like you just missed the run of going from $19 a share to 123. That the last 3 years was your time to get in on that bull run for the energy sector. Now, can it go on for another 3 years? Yes, it's possible. But as time goes on, it becomes more and more unlikely that this energy sector is just going to keep firing off. So keep that in mind. Are they innovative? Do they have a moat? Yes, I guess. We're talking about a different sort of innovation here. This isn't like a traditional technological innovation. But when I look through their investor presentation on the slide deck, they claim that they're innovating in certain ways to make their business model more efficient, which it's hard to argue with them. And I definitely would say they have a moat for being the 6th largest refinery company. Not anybody can just get to that level. That takes a lot of time. So that's definitely a moat. This is not an easily replicable business. Number 5, is the industry growing? Yes, refinery is supposed to grow between 2 to 5% over for the rest of this decade. So it's something. Let's see what do they analysts have them growing at? What? Probably something similar. So there you go. So EPS is supposed to go from, it was $26 last year. This year it's expected to come down to 19 and then 13. So there you go. It's going to drop 50% in 2 years. 50% this year, and the next year 11%. So that's just, it's to be expected. It's to be expected. That's why this wouldn't be the time to come into the stock. If we look at what their P ratio normally is, it's normally around a 7. Right now we're at a 4. So yeah, this stock will come back down to $60 or $70. That will happen. And that might be a good time to get in. I don't know. Okay, let's see. Return ROI. What's their ROI? ROI is, I gave this a no because it's 6%, 7%, 7%, 10%, 6%. And then 13, 19, 18, 28. I guess you could say they've done more years that were good than more years that were bad. We can keep that a yes. They did have a year under 7, but most of the years were over 7. Healthy cash flow. Once again, I guess you could say that. So now let's see. This number is going to change to a 12. But healthy cash flow, I guess you can say that. There's not a whole lot of data here for 2022, but we can see net income. Again, it bounces, 3 billion, negative 9.9 billion, but that was because of the pandemic. Normally that probably wouldn't happen. And then 11 billion. So, we're looking at data from a very volatile time that goes from the worst case scenario to the best case scenario. That's the numbers we're looking at for this company right now. So it's hard to say. This isn't we're not talking about Apple right now or some, easier to analyze company. Healthy cash flow, but again, obviously they're making big money, so there's not much you can say against them. Yeah, I mean, it's hard to. Let's go back to this. Let's look at their free cash flow chart here, because this gives us more years. Stock-based compensation, not important. So look at free cash flow. It's all over the place, right? It's all over the place. Do you consider that healthy? I'm going to consider that not healthy, because even though they have good years, they're having, just the fact that it's super random and unpredictable is not healthy. That's not a fun thing to deal with. So I'm going to give that a no. Equity. Let's see. Equity here. Equity 43, 30, 33, and then still 33. Overall, a decline. But remember, I mean, this is talking about going through the pandemic, so it's a whole different story here. It's a whole different story. So it's no, I guess. It's definitely over 15%. It's like more than half. Share count decrease, no. This is another one that's like borderline, could go either way, because we see multiple years of huge buybacks. And then we see years of huge increases, 518 million shares to 669 million, and they started lowering it again. So there's different ways to analyze this. I guess you could say I don't know. Again, it's not consistent. We want some consistency. Anybody can go, extreme in one direction, extreme in the other direction, but you're not really getting anywhere by doing that. Healthy amount of debt. Yes, I would consider this liabilities of $51 billion. Actually, let's go to the most recent. Yeah, $55 billion of liabilities, and we're talking $145 billion of assets and liabilities. So it's not like they're hugely over leveraged or anything. Not horrible. Respectable management, yes, I guess, because of the numbers they're putting up and the position and the power they have. You could say yes. Cash more than average annual income, yes. Right now we're talking 11.7 billion in cash, and their net income is normally under that. So they have plenty of cash relative to how much they make. Healthy dividend, it's only 2.4%, and a payout ratio of only 9.5% because their earnings were so high this year. Wait till this drops and all that money dries up. Over 20 years old, yes, it's more like 2,000 years old. This company was founded in 1887. So all in all, what do we have here? We have 1, 2, 3, 4, 5. So 11 out of 16 not considered a buy. Again, it's a huge company. It's a company of power. It's a company that can make ginormous amounts of cash when times are in its favor, such as 2021 and 2022. But going forward, if we look at 2024, 2025, I bet those numbers are going to be a lot weaker. We already saw what analysts have been doing. It's going to get cut in half in 2 years. So if you own the stock before those earnings come in, then you're in luck because you're probably going to double your money or triple your money. But if you buy it right now when they're at the peak of their business, and then numbers come down 50%, expect that stock price to come down 50%. And good luck coming back to that. If you buy it right now at $120 a share, good luck waiting to break even on that, because who knows when the next time we're going to have an energy cycle like the one we just had the last 3 years. It could be a decade. You might wait a decade to break even on those shares. So if you want to get involved in that sort of risk and reward, your best chance is going to be when the stock is down, right? Because the stock's probably not going to $5 or $10 a share, right? It's going to go to 60. It might go to 50. It might even go to 40, right? But the chances of this company going to a $5 billion valuation are very low. They're one of the biggest refinery companies in the entire world, and the oil industry is the largest in the world, worth trillions of dollars. So, and they have a huge moat. You can't just come in there and replace. You can't just come in there and replace them. So that's the thing you got to deal with here. Is you got to expect the ups and downs. You got to expect the volatility, and you have to pretty much time buying this stock at the perfect time. And same thing with selling, because if you hold this, the stock is probably going to be cut in half in a year from now. So just keep that in mind. And yeah, that's all for today. Thank you for watching. I will see you guys in the next video.